Hello and welcome to Market Insights. Thanks for joining us today. I'm Jim Armstrong with Fidelity. So if you've heard it once, you've heard it 1,000 times, especially in this past year. Interest rates are at historic lows. Now, that's not just some catchy TV commercial line, it's reality. And from the look of things, 2021 is expected to deliver more of the same. And while this might be a great time to refi your mortgage or finance a car, the picture's a little less rosy for people counting on interest rates to deliver part of a fixed income, like folks in retirement with money in bonds, for example, or even just for those of us who like to see cash savings earn a nice return every month. So that's what we're going to be talking about today, that double-edged sword of low interest rates, what's behind them from a market perspective, and what it means to each of us as investors. For today's discussion, we are proud to have Jurrien Timmer with us to give us a sense of what he sees when he examines our economy's big picture today and tomorrow. Leanna Devinney is also with us, thankfully, again, to talk about how she and her team of Fidelity representatives work with people to figure out how interest rates and a host of other factors all play into their financial planning. Remember that the views and opinions in this webcast are those of our speakers. This is a discussion meant for educational purposes and should not be considered investment advice. Leanna, Jurrien, off of a long weekend, it is great to have you here on Tuesday.
Great to be here. Thank you.
It's cold outside.
Well, welcome back to the Northeast. Now you know
Jurrien's back.
He's back, everybody. It's Tuesday, February 16th, Jurrien. Let's start with you, please. And again, the markets, and I think us as individual investors, we're all super curious about what is to come with interest rates. They impact, of course, how we spend and how we save. So we just would love your thoughts here to open us up.
Yeah, so just, we were talking about this last week as well when we were talking about inflation and what's kind of being priced into the stock market. And, we have some really good news to report here on the economy and the COVID-19. I was just looking at the data. There's a series that measures the number of hospital beds in the U.S. occupied by COVID patients. And just in the last month, the number of beds has gone from 20% of all hospital beds to 10%. So that is it's in 1 month it got cut in half. 48 million vaccine shots have now been administered. So the COVID curve is not only falling, but it's basically crashing, which of course is great news for obviously everyone who is possibly affected by COVID, but also the economy. And on top of that, we're likely to get close to $2 trillion of additional fiscal stimulus as early as next month. I mean, it's kind of mind-boggling, since the pandemic started. If we get this new bill, approved by Congress, we're looking at over $5 trillion of fiscal spending. And so when you look at the markets, we see that interest rates are rising, and that's to be expected because when things get better, it's kind of a good sign actually that interest rates are rising, because if they're not, it tells you maybe something is off. So what the market's pricing in is reflation, as we call it, a reopening of the economy. Hopefully it reopens for real this time, because we've had a number of false starts, of course, and that should allow the economy to kind of close what we call the output gap, right? The difference between actual growth and the speed limit or potential growth. And so from what I'm hearing, we could be at herd immunity over the summer. And then the thinking is that in the second half of this year, the economy could have like a little mini boom. Think of all the people with money to spend because of the CARES Act and unemployment benefits. Then the economy reopens and you get all that pent up demand. The COVID curve is coming down, and it all spells a stronger economy, maybe some inflation, and higher interest rates are sort of part of that mix. And so maybe if we pull up the first chart here, what we can see is that rates are rising, but they are rising for the right reason, and that's a little bit of a technical nuance because, and not to get too nerdy on you here, but when you look at interest rates or bond yields, there are two components. One is what we call the real yield, so that's the inflation-adjusted interest rate, and the other component are inflation expectations. And so if rates are rising because inflation expectations are rising, it doesn't do a lot of harm to the economy But if they rise because real yields are rising, then the inflation-adjusted cost of borrowing goes up, and that can have more contractionary effects on the economy. And so right now you can see the blue line are inflation expectations. The bars are the 10-year Treasury yield, and they're both rising in tandem. And that's a good sign. I think when the Fed looks at this, and we'll talk about the Fed in a moment, they're okay with this happening the way it is, and it's a sign that things are improving in the economy, and that yes, there'll probably be some inflation, but I think the Fed would view that as transitory and not structural.
Excellent. And Leanna, that takes me right to my question to you, sort of a more boots on the ground perspective, I guess. So low interest rate environment right now, historically low, despite what could be coming in the sort of medium term. I'm curious sort of how you see that double-edged sword there. These low interest rates are a financial win for some, a hardship for others. It really has to do with where we are in life, I think, and what our goals are. So maybe start us off talking about people who might see these low rates as an opportunity.
Yeah, we'll start with some of the positive mortgage rates. Student loans, credit cards, we'll cover all of those, but let's start with the mortgage rates. So they're quite low, and for a lot of people, they've been very enticing. We've seen people moving out of the cities to more open areas due to COVID, and certainly the 30 rates below 3% are very appealing. I was one of those. I moved from Boston to the suburbs last month, and I remember when we bought in the city, we were thinking historic lows, and it was north of 4.25% was our interest rate, and now below 3 out there. We're seeing so many clients, friends, family members taking advantage and refinancing. So as a general rule of thumb, if you're not buying and it's potential for refinance, if you can drop your interest rate by 0.5% or more, for example, it may be worth it. But again, you'll want to look at the fees and your overall financial picture to do so. And also, we've been giving the guidance to shop around and see what different lenders are offering as well. But one of the biggest questions that we get is how long will mortgage rates stay low? And Jurrien, I know you've been doing work on this and when mortgage rates could rise, but what are you seeing?
Well, so mortgage rates will generally follow the path of Treasury yields, but the spread between the two can change. And we know, for instance, that the Fed, which has added over $3 trillion to its balance sheet since the pandemic started, part of that $3 trillion has been in treasuries, but part of it has been in mortgage-backed securities, which of course is an attempt to keep mortgage costs down, because the Fed is doing all this because it wants the economy to recover back to its original potential. And the output gap went from 0 to 10%, now to 3%, and in all likelihood, it will close this year. But the Fed wants to make sure that it doesn't take the punch bowl away too quickly, as the old saying goes. And so if mortgage rates were to rise a lot, my guess is that the Fed would try to intervene, maybe by increasing its purchases or changing its forward guidance. But I think certainly the Fed is very much looking at this and wants to make sure that this economy can fully recover.
Exactly. And then on some of the other opportunities, just speaking on car and credit card. So the car loan market is similar in the mortgage market, where interest rates are low by historical standards, and there's plenty of competition to be able to shop around, and you can find interest rates, I've heard, as close to 0%. So again, it's understanding, they look at your credit history and income and want to understand your options. The credit cards move a little differently. The Fed's movement doesn't tend to have as tremendous immediate impact that we see on cars and mortgage. But I think it's an opportunity to just share. We saw a lot of spending habits change in the pandemic. We were home more, maybe not using our credit cards as much. So it's an opportunity to call your credit card companies and see if it's able to move those interest rates lower, and certainly an opportunity to assess your savings and spending and pay down debt as well.
Yeah, great advice. I've made that call myself in the past. Called up the credit card when I was carrying some debt and said, "Hey, can you do anything to help with the interest rate?" And surprisingly, they said yes. So that's a great way to save a couple of dollars if you can. Leanna, I also want to ask you about student loans, which I'll do in just a minute. But first, I want to return to this idea that Jurrien brought up about how long the low interest rate environment in general might last. Not just mortgage related, Jurrien, but in general. I think people have that question quite a lot.
Yeah, so the big question, so assuming that the market is correct, that the economy is going to go back to its full potential in the second half of the year, and that there'll be some inflation, which again mathematically is kind of almost a given because of the base effect, because we had deflation during the pandemic shock. The big question becomes, what does the Fed do about this, right? So historically, you have fiscal policy, right? So how much Congress spends, whether it incurs deficits or not. And then you have monetary policy. And the Fed, of course, since 1951 has been independent from fiscal policy. And so what will often happen is that when fiscal policy is more loose, like for instance it was in 2016, 17, 18 during the tax cuts from the previous administration, the Fed leaned into that by raising rates, normalizing policy, as the Fed politely puts it, and it acts as a counterbalance, checks and balances, if you will. So that's normally how it works. So you would think, okay, the economy returns to full potential. As inflation goes up, at least for a while, you would think the Fed would then take advantage of that and normalize policy, bring rates back to, let's say, 2%, reduce its asset purchases. And I think eventually that will happen. But my sense is that right now, the Fed, because it has undershot its 2% inflation target for so long, for the last 10, 12 years, that it's going to give the market the benefit of the doubt and say, you know what? We're going to let this thing run hot so that unemployment comes back to its old lows of around 4%. And then if inflation happens and it's sticky, maybe then we'll normalize policy. But I think that will happen later, and that will allow the economy to improve further. Now, that doesn't mean that interest rates are not going to rise. But again, like I said before, it's a distinction between real rates and nominal rates. And if nominal rates rise and real rates do not, then I think that's something that will not do a lot of damage to the economy. And so what I'm looking at right now is for signs that the Fed is either going to stay the course and keep policy very loose, or start to kind of normalize policy. And the way I do that is, if you look at this chart here, the blue line is the 10-year Treasury yield. So it's gone from 0.5% to 1.2%. I think today it's even 1.28%. The yellow line is the Fed funds policy rate. So that's the official monetary policy rate. It's basically near zero. And then the dark blue line is what we call the forward curve, what the market is expecting the Fed to do. And often that is driven by what the Fed is telling the market it's going to do, right? So it's a little bit of a circular loop, but you can see that line is basically as flat as a pancake. And that goes out to 4 years from now. So the market is expecting the Fed to do nothing, even though the economy is going to hopefully fully recover. And that does impact interest rates to some degree, right? When rates rise, in part, it's the math of expecting higher rates in the future. And if that doesn't happen, then real rates will be able to continue to stay negative. And then if rates do rise more than they have, it will be from the inflation side. And I realize this is very technical, but it is an important nuance for how the markets function.
No, great context. Thank you for taking the time to walk us through that. Leanna, I did want to come back to that question for you about student loans. Massive debt burden for so many people, Fidelity customers, people, everybody, right? Carrying student loans, really of all ages. What are some of the opportunities you see there given these low rates?
Yeah, so high level, the market for student loans is split into federal and private lenders. And we certainly will help those take a look at what their interest rates are and potentially consolidate and strategies to spend down. But can be a lot to it versus other than what just the interest rate is. So for one thing, we are seeing there is potentially going to be some kind of relief for the federal student borrowers that may be on the way from the Biden administration. So we're not sure what that program will look like, and it's a little unclear at the moment, but that's something to wait for on the federal side. Other actions to consider, there's forbearance. You want to consider your overall financial picture, of course, but that forbearance typically allows you to delay payments for a period. We did see that a lot in 2020. But the principal gets tacked onto at the back end of the loan, which may then make your debt bigger in the longer run. So there are options to consider. If you have private loans, then you might consider shopping around for rates to refinance your student debt. So similar to what we talked about refinancing, like on the mortgage front, you can do that on the student loan as well. And I would just say, keeping in mind overall economic conditions in the US could affect that lending. It's always evolving.
Great, interesting perspective there about the refi for student loans too. That's pretty useful. I do want to ask you another question, Leanna, about kind of the other side of that low interest rate coin. You ran us through some of the options to take advantage of low rates, but what about folks, maybe some people watching right now who are counting on higher interest rates, hoping for higher rates as a way to provide income? I'm thinking especially of people who are retired or are getting close to retirement, looking at the chart Jurrien laid out for 4 years of relatively low rates and maybe getting nervous about that.
Yes, so this is the other side of the double-edged sword that we talk about. So in a low interest rate environment, it's that question of where do I get my yield from or my income, especially if I'm in retirement, how am I going to take from my investments, especially if it's not in our cash accounts and with bond rates so low. So when we speak with our clients, we really do share the ways to take income, especially when you're retired. So our withdrawal rule of thumb has been 4%. So this slide here is showing the impacts of withdrawals in retirement. Mm-hmm. And these different squiggly lines that we can see, it's showing, well, what if I took 4% versus 5%, 6%, 7%? So the 4% is the yellow gold line we can see here on the top. And what you can see is you do not run out of money. You don't outlive. The account is invested. That's a key part of this. It's not sitting in cash.
Right.
It's assuming we're invested in a balanced portfolio. So that would be 50% more on the equity side, 50% in bonds and cash, and you don't run out of money. Just by taking a percentage more, going from 4 to 5%, that green line, you can see that the money is gone before age 90. 6%, 7%, it becomes more extreme. So we talk with the assumptions of that 4% rule and how to take income in a low interest rate environment. And there's strategies out there to build a portfolio that's well diversified so that you can take income to spend for your lifestyle and retirement.
Excellent.
I would just add, Leanna makes a really tremendous point here because all of this depends on, how long our money lasts, depends on how well it can compound over the long term, right? So even a 1% increase in your spend, it puts you behind the curve in terms of recompounding those gains. And it just shows you how sensitive it is. So this is a really great chart.
Excellent. Hey, Jurrien, another question for you. I want you to maybe put on your history hat, if you could. I know that you spend a lot of time thinking about what the future could look like based on history. And I know you've done some thinking about the 1940s in particular. So maybe you could just make a connection there about what you see and what it might mean for our future interest rates.
Yeah, so this is an analog that I've been looking at for the last year, because this is the one time, or not the one time, but this is basically the last major time in history where fiscal and monetary policy were aligned. So the 1940s analog obviously relates to World War II, mm-hmm. and the U.S. Joining World War II in the early to mid 40s. And obviously, the U.S. had to incur a lot of debt as it mobilized the economy to enter, obviously, a major world war. And that's very costly. The debt to GDP went from, I think, 35% to 116%. And the Fed played its role. The Fed was not yet independent at the time. So it played its role by essentially monetizing that debt, by buying an equal amount of treasuries that the U.S. was issuing to pay for the war. And at the same time, the Fed kept interest rates very, very low at 1%, even though inflation was rising. And so that, I think, is a similar backdrop to today, because the debt level is similar. It's about 120% of GDP, and the Fed is buying almost as many bonds as the U.S. Treasury is issuing, and interest rates are kept at a very low level. And so for me, the punchline is that if this analog is the right one, and of course history never repeats, but it can rhyme, that even as inflation maybe reappears and the economy starts to expand again, that the Fed will keep monetary policy very, very loose, because when debt levels are this high, you can't really afford for interest rates to rise. I mean, and that applies to people as well as to governments, because the more you spend on debt, the more sensitive you are to the servicing costs of that debt. So this is an analog that I think has worked well. You can see in the bottom panel the real interest rate, again, the one we've been discussing. If that's the case, real rates will continue to be negative, and that will be very positive for the economy as we go forward.
Excellent. Thank you for that. Such tremendous implications for all of us as investors. So I want to thank you both for taking the time to be with us today. And for everyone watching, of course, thank you for joining as well. If you're looking for help with your financial planning, or just got questions about building or updating your current plans, consider visiting our website or download the Fidelity app on a mobile device and check those out if you haven't already. They're both great ways to start getting your questions answered about interest rates and about a whole host of other things. So definitely something to consider. Again, huge thanks to Fidelity's Leanna Devinney and Jurrien Timmer. And once again, thank you for joining us. Stay safe, be well, and we hope to see you here next week when we'll be talking about your long-term care needs and the expenses associated with them for yourself and for your loved ones, something definitely top of mind, particularly these days. So we hope to see you then.